Okay, let's unpack this. Usually when we talk about investing in the stock market, there is this expectation of precision, right? Like engineering.
Oh, absolutely.
You pull up a company's financial report, the chart shows that jagged green line going up and to the right, and an analyst just points and says, there it is. That is the value.
Yeah, it feels binary, right? Profitable or not profitable. It's clean and, well, it's comforting.
Yeah.
We really like things to be visible, to be categorized neatly into columns and rows.
We really do. But then you step into the world of heavy industrial manufacturing, global supply chains, multi-year infrastructure projects, and suddenly that clean X-ray machine is just totally broken.
Right. It's shattered.
We are looking at a diagnostic landscape that is honestly incredibly murky. You have revenue recognizing today for work that was actually sold, 3 years ago?
Exactly. 3 years ago, easily.
Right. And you have copper prices fluctuating wildly based on global macroeconomic conditions and these massive geopolitical shifts moving the tectonic plates underneath it all.
It is the absolute definition of muddy waters. You really cannot look at a single snapshot of revenue and understand what is actually happening on the factory floor today.
Which is exactly why we are adopting our Talk Tickers framework today and putting Powell Industries, a ticker symbol POWL, under the microscope.
A fascinating deep dive.
Yeah, we are breaking down their officially released Q1 2026 earnings call transcript featuring CEO Brett Cope and CFO Mike Metcalf. And we are going to clear that mud.
I love it.
Because on the surface, Powell Industries sounds like the kind of traditional, gritty, heavy industrial manufacturer that, your grandfather might have bought stock in and just completely forgotten about.
Yeah, totally. They bend metal, they build electrical switch gears, they make these big, heavy, incredibly complex boxes that safely distribute high voltages of electricity.
Right. And for decades, that was the entire narrative. A steady, predictable, somewhat cyclical business tied mostly to traditional energy markets.
But what's fascinating here is how, as we dig into this transcript, the narrative completely flips.
It really does.
This company has somehow positioned itself as a backdoor play into the two hottest, most capital-intensive trends on planet Earth right now. We're talking artificial intelligence data centers and global liquefied natural gas, or LNG.
Yeah, and we are going to get into the story behind all of that, management guidance, and ultimately give you an actionable, opinionated bottom line for retail investors.
Because this single earnings call serves as a perfect microcosm for a massive global transition in physical infrastructure.
So true.
We spend so much time in the broader market talking about AI in terms of software, large language models, algorithms, lines of code, but none of that exists without the physical world.
Like actual metal.
Exactly. It requires vast, unprecedented amounts of electrical power. And that power doesn't just magically flow from a high voltage transmission line directly into a server rack.
Right. You'd blow the whole thing up.
You'd vaporize it. It has to be stepped down, distributed, controlled, and protected by incredibly complex, highly engineered physical equipment. And that is exactly what Powell does. They're the physical bridge between the power grid and the digital future.
And before we can even begin to talk about that future, right, before we can talk about the mechanics of the AI revolution or the massive export of natural gas, we have to establish the sheer financial velocity that Powell is experiencing right now.
The headline numbers.
Yes, the headline numbers. And frankly, they are staggering. So Q1 2026 revenue came in at $251 million. That is a 4% increase year over year from the $241 million they reported in the same quarter last year.
Which is, a solid, if seemingly modest, top-line growth at first glance.
Right. 4% isn't exactly tech stock growth. But wait until we move down the income statement. Net income was $41.4 million, translating to $3.40 per diluted share.
That's a big jump.
Yeah, a 19% jump from last year's $34.8 million. But here's the number that should make any investor sit up straight in their chair. New orders.
Oh yeah, this is the one.
In just this single 3-month window, Powell booked $439 million in new orders.
Just massive.
That is 63% higher year over year. It is the highest quarterly total they have seen in over 2 years.
And that order velocity, that is the metric that dictates the entire future of the company. It completely overshadows that 4% revenue growth you mentioned.
Absolutely. And because of that massive influx of new orders, their total backlog, the total value of work they have contracted but haven't yet performed, has swelled to a record-breaking $1.6 billion.
$11.6 billion. Just think about that for a heavy industrial company.
It's crazy. That's up 219 million year over year and up 191 million just sequentially from the previous quarter. And all of this translates to a book-to-bill ratio of 1.7x.
Which we really need to pause here and translate that Wall Street jargon, because in the context of heavy industrial manufacturing, a 1.7x book-to-bill is an incredibly powerful signal.
Yeah, break that down for the listener. What does that actually mean?
Sure. So just as a refresher on how this metric behaves in this specific sector, a ratio exactly 1.0 means you are perfectly replacing your inventory of work.
Okay.
You ship $1 of switchgears, you sign a contract for $1 of new switchgears, a perfectly balanced scale. If you drop to, say, 0.8, you're burning through your backlog. You're shrinking.
But at 1.7x.
Right. 1.7x. For every single dollar of product they finished, shipped to a customer, and billed for in the first quarter, they booked $1.70 in brand new orders.
Wow.
They are shoveling coal into the engine 70% faster than the engine is actually burning it.
That is such a great way to picture it. And when you scale that up to a $1.6 billion backlog, that safety net becomes just monumental.
It really does. In the earnings call, CEO Brett Cope explicitly stated that this backlog gives them project visibility that now extends all the way into their fiscal year 2028.
2028. We're talking years of runway.
Yes. For a heavy manufacturer, having your production schedule largely spoken for 2 to 3 years in advance, it removes an incredible amount of risk from the business. It fundamentally alters how management can operate.
Because they aren't guessing what the market will do next quarter. They already hold the signed contracts.
Precisely. And that allows them to plan massive capital expenditures, right? They can negotiate long-term supply agreements for raw materials with extreme leverage, and they can hire specialized personnel with deep confidence.
Yeah, they aren't hiring engineers hoping to win a bid.
No, they're hiring engineers because the bid's already won, the contracts are signed, and the physical work simply must be completed by 2027.
Okay, but looking at these numbers, I want to unpack a stark discrepancy here that I think is crucial for understanding how this business actually operates.
Okay, let's hear it.
So wait a minute. They booked 63% more orders compared to last year. That is explosive growth. But their actual revenue, the money they recognized for completed work, only grew by 4%. I know we briefly touched on this, but let's really dig into the lag here. If I sell 63% more goods, my revenue should ideally reflect that massive jump, shouldn't it?
Well, if you're selling software subscriptions or, consumer electronics like iPhones, absolutely.
Yeah.
The revenue recognition is almost instantaneous.
Right. You swipe the credit card, boom, revenue.
Exactly. But that is not how long-cycle industrial manufacturing works, and this is the foundational concept for analyzing a company like Powell. These aren't products you just pull off a warehouse shelf.
No, not at all.
These are highly engineered, massive electrical substations and switchgear modules. Some of these modules, particularly for the offshore energy sector, are literally the size of multi-story buildings.
Right. They build custom offshore modules for oil rigs and these massive control rooms for utility companies.
Yeah. So a single project can take anywhere from 12 to 36 months to move through the entire life cycle.
Wow, 3 years for one project.
Easily.
Yeah.
You have the initial design phase, the rigorous engineering and safety approval phase, procurement of highly specialized raw materials, third-party components, the physical fabrication of the heavy steel enclosures.
And the wiring, right.
Oh yeah, the complex wiring of the copper bus bars, exhaustive factory acceptance testing, and finally, delivery and commissioning at the client site. So the revenue they reported this quarter, that $251 million, representing a 4% increase that is largely a reflection of orders they booked perhaps a year or even 2 years ago, winding their way to completion today.
I see. So the revenue is effectively an echo of the past. It's telling us what the business looked like in, say, 2024. But the new orders and the massive backlog, that is the voice of the future.
That is the perfect way to look at it. And furthermore, CFO Mike Metcalf made a specific point in the transcript regarding the 4% growth that adds some really needed context.
Oh.
He reminded the analysts that Powell's fiscal first quarter, which runs through the end of the calendar year, is historically their softest quarter because of seasonal holiday disruptions.
Ah, right. Fewer working days in November and December, Thanksgiving, Christmas.
Exactly. Clients take time off. Massive construction sites shut down for the holidays. Logistics just slow down globally. So generating 4% top-line growth and a 19% jump in net income during your seasonally weakest quarter is actually a very strong operational signal.
But the true story, the screaming headline of this quarter, is that avalanche of new orders.
100%.
Which brings us to section 2, the story behind the numbers. Because now that we see this massive orb of $439 million in new orders, we need to answer the most vital question. Where is this money actually coming from?
Right. Who is writing these checks?
Exactly. Because if you look at Powell's history, for decades, they were known primarily as an oil and gas player. They built the electrical infrastructure for massive refineries and petrochemical plants down on the Gulf Coast.
That was their bread and butter.
But this transcript reveals a fundamental pivot in the DNA of their customer base.
It really is a profound shift. For the first time in the entire history of Powell Industries, the electric utility sector and the commercial and other industrial sector now make up the majority of their massive $1.6 billion backlog.
That's huge.
Yeah. The legacy oil and gas business is no longer the undisputed king of their balance sheet.
Let's look at the data driving that, because we always want to be data forward.
Yeah.
According to the transcript, data centers specifically now account for roughly 15% of their total backlog.
15%. That's a massive slice of a $1.6 billion pie.
And the broader commercial and industrial sector sits at 22%. But the real highlight of the quarter was Powell securing a single massive $75 million mega order specifically for one data center.
That $75 million figure is just extraordinary for a single facility's electrical distribution equipment. It really speaks to the incomprehensible scale of modern AI data centers.
Yeah, explain that scale for us.
Well, we aren't talking about a room full of web servers anymore. We are talking about hyperscale facilities drawing hundreds of megawatts of continuous power.
I want to frame this because people talk about AI in terms of, OpenAI, Microsoft, Google, the software. They treat it like it exists in the ether, like magic.
Right, the cloud.
Yeah, the cloud. But looking at the $75 million single order, it really hits you. Everyone is trying to pick the winning AI software company, but Powell is just selling the picks and shovels during a gold rush.
That is a phenomenal analogy.
They aren't the software. They are the vascular system of the AI revolution. If a large language model is the brain, Powell is building the physical arteries that ensure the blood, meaning the electrical power, actually gets to the processors regardless of who wins the AI race.
And it ensures it gets there without bursting a vessel or causing a catastrophic blackout.
Yeah.
It cuts to the heart of the engineering challenge. Because of the power density of these new server racks, particularly the ones housing the advanced NVIDIA GPUs used for AI training, it is entirely unprecedented.
How much more power do they need?
Well, a traditional data center rack might have drawn, say, 5 to 10 kilowatts of power. These new AI clusters can draw 40, 50, even 100 kilowatts per rack.
It's an astronomical increase in energy density.
It is. And when you bring hundreds of megawatts of high voltage power from the utility grid to the edge of the data center property, it is raw, dangerous, and totally unusable by the delicate microchips.
Right, it would just fry everything.
Instantly. It has to be stepped down from perhaps 115 kilovolts down to 480 volts, and it has to be distributed across hundreds of thousands of square feet with absolute zero tolerance for voltage drops or surges.
Zero tolerance.
None. It requires massive switchgears, incredibly robust circuit breakers, and complex protective relay logic. Because if a breaker fails or if a switchgear overheats and faults, an entire cluster of AI training worth tens of millions of dollars goes offline.
So the reliability requirement is just off the charts. The AI companies literally cannot afford for the power distribution to fail.
And that is exactly why a single order for the electrical gear can hit $75 million. And, CEO Brett Cope highlighted something fascinating about this shift toward data centers during the Q&A segment of the call.
What was that?
He contrasted their historical oil and gas business with this new tech boom, and it fundamentally changes their manufacturing strategy. Historically, a massive petrochemical project for Powell was highly bespoke.
Okay.
It was uniquely engineered from the ground up to fit a specific refinery's footprint, dealing with specific hazardous gases and integrating into a very specific aging legacy power grid.
So every single petrochemical project is a unique snowflake. It requires custom engineering, custom enclosures, custom everything.
Exactly. It is complex, it is slow, and requires heavy custom engineering hours for every single unit shipped. But Cope noted that the data center market is shifting Powell toward a design one, build many manufacturing strategy.
Oh, wow. Which is a massive leap forward for operational efficiency.
It changes the entire margin profile of the business. Data centers, while massive, are relatively standardized environments compared to a 1970s oil refinery.
Right, a server farm is a server farm.
Basically, yeah.
Yeah.
So instead of reinventing the wheel for every order, Powell can collaborate with a hyperscaler to design a highly optimized, standardized electrical distribution skid. Once that design is locked in, they can just pump them out on an assembly line.
So they transition from being like a custom tailor, hand-stitching bespoke suits to mass-producing high-end modular components on a factory floor.
Exactly. Cope specifically mentioned that this standardization will allow for a lot more flow-down production lines. This reduces the engineering hours required per unit, it speeds up the manufacturing cycle time, and it allows for bulk purchasing of standardized raw materials.
Which has to be great for the bottom line.
Oh, absolutely. Ultimately, it should lead to significantly higher profit margins on these data center orders once they fully scale up the production process. They're streamlining their own operational DNA.
The volume of demand is just astronomical. Now, data centers are the flashy, high-growth tech story, right? But we cannot ignore the other giant catalyst that was absolutely dominating this earnings call.
Right, the other side of the coin.
Liquefied natural gas, or LNG. Because while the AI boom is new, this is a massive resurgence of their historical core competency.
It is a critical piece of the puzzle. While their petrochemical revenue was actually down 31%, mostly because a massive multi-year 2023 project finally wrapped up and rolled off the books, their overall oil and gas revenue was still up 2%.
Which shows resilience.
It does. And crucially, it still commands about 30% of their total $1.6 billion backlog. And the absolute crown jewel of that segment this quarter was a mega order that exceeded $100 million for a single U.S. Gulf Coast LNG project.
Over $100 million for one facility's electrical gear. That is, we need to dig into why LNG is suddenly experiencing this massive renaissance, and physically, why an LNG export terminal requires that staggering level of highly engineered electrical infrastructure.
Well, the renaissance goes back to massive macroeconomic and geopolitical shifts over the last few years. Following the severe disruption of global energy markets, particularly the severing of Russian pipeline gas to Europe, there was a sudden, desperate global need for secure, reliable energy.
Right. Everyone needed gas immediately.
Exactly.
Yeah.
And the United States has aggressively positioned itself to fill that void, becoming the primary supplier of natural gas to the world. But here is the logistical nightmare. You cannot just pump natural gas across the Atlantic Ocean.
Obviously not.
And you cannot put it on a ship in its gaseous state because it takes up far too much volume.
Right, you have to shrink it down. You have to cool it to, negative 260 degrees Fahrenheit?
Spot on, negative 260.
So it condenses into a liquefied natural gas, which shrinks its volume by about 600 times.
Exactly. And freezing vast amounts of natural gas to negative 260 degrees on an industrial scale requires massive continuous refrigeration.
We are talking about compressors the size of large buildings, right?
Huge compressor trains. And those compressors are driven by incredibly massive electric motors, which require an immense, steady, highly reliable flow of electricity.
So it's just as power hungry as an AI data center.
In many ways, yes. And if the power blinks at an LNG export terminal, even for a moment, the refrigeration cycle breaks down.
Oh, man.
Yeah, the incredibly cold liquid gas begins to warm up and expand rapidly back into a gas, what they call boil-off gas. Pressure builds up in the pipes. Safety relief valves have to blow to prevent an explosion, and you lose millions of dollars in production and flared gas almost instantly.
So just like the AI data centers, the cost of an electrical failure at an LNG terminal is catastrophic. They need industrial-grade, fail-safe electrical switchgears, immense motor control centers, and instantaneous backup systems.
And they need it housed in specialized enclosures that can withstand the incredibly harsh, corrosive, hurricane-prone environment of the U.S. Gulf Coast.
Right, salty air, massive storms.
Exactly. Powell specializes in exactly this. They build massive, climate-controlled, blast-resistant electrical houses, sometimes called E-houses, that contain all the sensitive switchgear.
Wait. They built a whole building.
A whole modular building.
Yeah.
They test it thoroughly at their own facility and then barge the entire building down the coast to the LNG site.
And the timing of this is crucial, right? The permitting process for these massive facilities on the Gulf Coast, both brand new sites, which they call greenfield, and massive expansions of existing sites, which are brownfield, was essentially paused by regulatory agencies for a period.
It was, yes.
But that pause lifted roughly a year ago.
It means all of those delayed mega projects representing billions of dollars of capital expenditure, are suddenly coming to market simultaneously, all fighting for the very same specialized electrical infrastructure.
So Powell is catching an incredible double tailwind here. You have this massive legacy business coming back online with Gulf Coast LNG, hitting at the exact same moment that the AI data center demand is going parabolic.
It is a perfect storm of demand for heavy electrical infrastructure. And, we shouldn't forget the utility sector itself.
The people making the power.
Right. The utility companies that are actually responsible for generating and transmitting all this power to the data centers and the LNG terminals. Their revenue with Powell was up an incredible 35% year over year.
Wow.
So Powell is selling to the power generators, they are selling to the power users in the data centers, and they are selling to the power exporters in LNG. They are monetizing every single node of this infrastructure build out.
Okay, so the demand story is bulletproof. The revenue is there. The backlog is a mountain. But this leads us to Section 3, what is arguably the most important part of analyzing a heavy manufacturer. I like to call it the margin miracle, or perhaps supply chain judo.
Supply chain judo, I like that.
Because securing $1.6 billion in orders is fantastic on paper, right? But in a world of persistent inflation, supply chain snarls, and incredibly volatile commodity prices, having a big backlog doesn't mean a thing if you can't actually extract a profit from it.
Very true.
You could easily have $1.6 billion in revenue and post a devastating net loss if your raw material and labor costs spiral out of control over a 3-year build.
This is historically the great trap of heavy industrial contracting. It has bankrupted massive construction and engineering firms in the past.
Right.
You sign a fixed price contract to build a massive project over 3 years. A year into the build, the cost of raw steel skyrockets, the cost of the thousands of pounds of copper you need doubles due to global shortages, skilled labor rates go up.
And suddenly, that highly profitable contract turns into a massive bleeding liability that drains the company's cash reserves.
Exactly.
But looking at the transcript, that is absolutely not what is happening at Powell. Let's look at the margin data. Gross profit came in at $71 million. That is up $12 million year over year.
Solid.
But more importantly, the gross margin percentage hit 28.4%. The transcript notes this is an improvement of 380 basis points year over year, and their trailing 12-month margin is sitting at roughly 30%.
Which is phenomenal.
Now let's translate again. For the listener, what is a basis point?
Good call. A basis point is just 1/100th of a percentage point. So 380 basis points simply means an increase of 3.8%.
Okay, thank you. And for heavy industrial manufacturing, where you have massive factories, thousands of union or highly skilled laborers, and high raw material costs, operating at nearly a 30% gross margin is just exceptional.
It really speaks to extreme operational efficiency and phenomenal pricing power.
But the transcript reveals exactly how they achieved that 380 basis point jump. And this is where it gets a little technical, but it's incredibly important for understanding the underlying health of the business.
Yeah, the mechanics of it are fascinating.
CFO Mike Metcalf explicitly stated that 300 of those 380 basis points were driven by what he called project closeouts. Now, looking at how long-term industrial accounting works, that tells me they are finally releasing the contingency funds they've been holding on to for the last 2 years. When they finish a project under budget, that emergency fund acts as a sudden injection of pure profit. Is that exactly what's driving this?
Spot on. It is a fascinating and somewhat conservative quirk of how companies like Powell handle their finances.
Walk us through it.
Well, when Powell signs a $100 million contract that'll take 2 to 3 years to complete, they do not just guess their profit margin. They build a highly detailed, line-by-line budget. And crucially, they build contingency funds into that budget to cover unknown risks.
Like what kind of risks?
Oh, maybe extreme weather delays at the port, minor rework on the factory floor, or unexpected minor material price hikes. It is essentially a financial emergency fund for that specific project.
So under standard accounting rules, as they build the project over those 2 years, they recognize a portion of the revenue and a portion of the expected baseline profit based on their percentage of completion. But they hold that contingency fund in reserve.
Right. They don't count it as profit because they genuinely might need to spend it to fix a problem.
Makes sense.
However, when the project finally finishes, when they achieve project closeout, pass all the factory acceptance tests, and hand the keys to the customer, if they executed perfectly and didn't need to touch that emergency fund, all of that reserve money is suddenly released.
Wow.
And because all the costs for the project have already been accounted for, that release contingency flows straight to the bottom line as pure profit in the quarter the project closes.
Which artificially spikes the gross margin for that specific quarter.
Yes. Furthermore, Metcalf mentioned recovering costs via change orders.
Oh, right. Change orders.
In these massive multi-year builds, a customer will almost always change their mind halfway through the project. They decide they need a different specification, an extra breaker, or a modified layout.
And Powell charges them for that?
Exactly. When that happens, Powell charges them a premium for that change order, which also drives up the final margin upon closeout. So a massive wave of project closeouts contributing 300 basis points to the margin this quarter means that over the last 2 to 3 years, Powell's project managers executed their builds flawlessly, stayed strictly under budget, didn't dip into contingencies, and successfully negotiated highly profitable customer change orders.
Okay, that brilliantly explains the great performance in the past. It proves their operational execution was flawless over the last 2 years.
Yes, it does.
But looking forward, I have to play devil's advocate here. If I'm an investor looking at this business today, I am terrified of future commodity inflation.
Naturally.
We just established that these are 2 to 3 year projects. Powell uses mountains of copper for the electrical busing inside their switchgears and literal mountains of steel for the blast-resistant enclosures.
Huge amounts of raw material.
If Powell locks in a 3-year, $100 million contract today based on copper at, say, $4 a pound, and suddenly a global grid expansion shortage sends copper to $8 a pound next year, don't their future margins just get completely wiped out? How do they survive that without taking massive losses?
It is the most critical risk factor you can identify. And an analyst named Manish Somaiya actually pressed management on exactly this during the Q&A.
Oh, he did? And what did they say?
CFO Mike Metcalf gave what can only be described as a masterclass in risk mitigation. Powell does not just cross their fingers and hope copper stays cheap over a 3-year build. They employ aggressive financial and contractual strategies to flip the risk.
This is the supply chain judo. How exactly are they flipping the risk away from themselves?
First, Metcalf explained that they actively hedge their copper exposure in the financial markets.
Okay, so they're trading futures.
Exactly. The moment they sign a massive contract with a customer that requires a specific tonnage of copper, Powell's finance team uses financial instruments, futures contracts, to lock in the price of copper at that exact moment.
So if the physical price of copper doubles a year later when they actually need to buy it for the factory floor, their financial futures contract pays out, effectively offsetting the higher cost of the physical metal.
Exactly. They neutralize the commodity volatility. Furthermore, they build potential raw material price hikes directly into their pricing models when bidding on the job.
So the customer pays for the risk.
Exactly. If they expect inflation, the customer pays for it upfront in the contract price.
Okay, so they use the financial markets to protect the raw metal costs. But an advanced switchgear isn't just raw copper and steel, right? What about all the complex third-party technology inside it?
That is the second and arguably more brilliant part of their strategy. A Powell electrical module includes a lot of what Metcalf called engineered components that Powell doesn't actually manufacture themselves.
Like what?
Things like highly specialized HVAC systems to cool the power electronics, advanced automated fire suppression systems, or very specific proprietary protective relays from other manufacturers.
Okay, so they have to buy those.
Right. And Metcalf stated that the very moment Powell signs a contract with a client, they instantly turn around and sign binding purchase orders with their sub-suppliers to lock in the prices of those engineered components.
Ah, so they don't wait a year to order the HVAC system. They lock the price today.
Exactly today.
So if inflation drives up the cost of an industrial HVAC unit a year from now, that is the HVAC supplier's problem, not Powell's.
Exactly. They shift the inflation risk entirely down the supply chain to the sub-tier vendors. They lock in their costs on day one, ensuring that the highly profitable margin they modeled when they bid the job is ironclad over the 3-year life cycle.
That's incredibly smart.
It is. This combination of flawless factory execution leading to profitable closeouts and aggressive financial and contractual hedging to protect the backlog is why their margins are expanding even in an incredibly volatile macroeconomic environment. They have built a financial fortress around their operations.
Okay, so we've established the demand is historic, driven by AI and LNG, and their ability to protect their profit margins on that demand is locked down tight. This brings us to Section 4. management guidance, and the operational reality of the future.
Right, looking ahead.
Because management has the demand, they have the protected profit margin now. What are they telling us about their physical capacity to actually deliver on this $1.6 billion backlog? Because a backlog is just a piece of paper, a promise, until you actually bend the metal and build it.
And this is where the operational rubber truly meets the road. We established earlier that their book-to-bill is 1.7x.
Right.
If you have 70% more orders coming in than you can currently manufacture and ship out, your factories are maxed out.
Yeah.
You are operating at capacity limits.
You need more space.
You have to grow your physical footprint. And to grow your physical footprint in heavy manufacturing, you need massive amounts of cash.
Well, let's look at the balance sheet data from the transcript because it is pristine. Powell is sitting on a cash and short-term investments of $501 million.
$500 million.
And here is the absolute kicker for me. They have absolutely zero debt.
None. Zero long-term debt.
It's unheard of.
In a macroeconomic environment where interest rates have been punishingly high, crushing the balance sheets and profitability of debt-laden industrial companies, Powell is sitting on a $500 million fortress.
Earning interest, too.
Oh, yeah. Earning roughly 5% interest on that cash pile means they are generating around $25 million a year in pure interest income just by sitting on it.
But they aren't just sitting on it. The transcript outlines incredibly aggressive capacity expansions to handle this backlog. They are currently physically expanding their massive Jacinto Port facility.
Right, their port facility.
Now, Jacinto Port is a highly specialized deep-water port facility on the Gulf Coast designed specifically for building, staging, and shipping those massive offshore LNG modules that have to be moved by barge.
Because you can't put them on a highway.
Exactly. That expansion is slated for completion in the second half of 2026, which aligns perfectly with the timeline for those mega LNG orders.
Perfect timing.
On top of that, Brett Cope noted they just signed a lease and took ownership of a new 50,000 square foot facility. And what's interesting here is this space is designated specifically to hold inventory and support the product flow for the data center business.
And that ties perfectly back to our earlier discussion about the transition to a design one, build many manufacturing strategy for AI data centers.
Right. The assembly line.
If you are going to run an optimized assembly line for standardized data center equipment, you can't have raw materials arriving just in time and clogging up the factory floor. You need massive warehouses just to stage the standardized parts, the breakers, the standardized enclosures, the cooling units.
So that's what the 50,000 square feet is for.
That is exactly what it is for. It is a logistical staging ground specifically designed to feed the AI boom assembly line.
But wait, the expansion plans get even bigger. During the Q&A, an analyst asked about future capital expenditures, or CapEx, moving forward, and CEO Brett Cope casually dropped that they are in active discussions with the board of directors about building a brand new, ground-up manufacturing facility that would cost on the order of $100 million.
And this is exactly where that $501 million cash war chest becomes a devastating competitive superpower.
How so?
Well, if a competitor wants to build a $100 million factory today to try and steal some of this AI market share, they have to go to a bank, take out a massive loan at 7 or 8% interest, and saddle their balance sheet with expensive, risky debt.
But Powell
can simply write a check. They can self-fund massive capital expenditures to chase this AI data center boom without taking on a single dime of debt and without diluting their current shareholders by issuing new stock. They control their own destiny entirely.
It is the ultimate position of strength in a capital-intensive industry. But, no company is invincible, and we have to look at the friction points. Where are the actual bottlenecks holding them back today?
Yeah. Management was surprisingly transparent about this in the transcript.
They really were. Brett Cope openly admitted that labor constraints, specifically what he called fixed-side engineering labor, is their current primary bottleneck.
It is the classic industrial growing pain. You can use your cash to build a new factory in 12 months, but you cannot manifest a senior electrical engineer with a decade of specific industry experience out of thin air.
Let's define what a fixed-site engineer actually does in this context, because they aren't just sitting there drawing schematics all day, right?
No, these are the highly specialized engineers responsible for the complex, customized integration of these massive systems. Even with standardization, every data center or LNG plant has unique grid connection requirements.
Right, they all plug into a different part of the grid.
Exactly. These engineers design the physical routing of the massive copper bus bars to handle immense thermal loads. They designed the incredibly complex relay logic, the brain of the switchgear, that determines exactly when a breaker should trip to prevent a catastrophic meltdown.
And there's a shortage of these engineers.
Yes. Cope noted that the sheer velocity and technical complexity of the data center growth is really challenging their engineering capacity today. They have to design these new standardized product lines while simultaneously executing the complex legacy backlog, and they simply need more engineering brainpower to do it.
Did he give a timeline on fixing that?
He expressed confidence they will solve this specific labor crunch in the next 90 days, but it is a real, openly acknowledged friction point, limiting their immediate growth speed.
And beyond the labor constraint, there is another risk, a massive psychological risk in the broader market that I want to bring up. I call it the phantom backlog risk, or the toilet paper effect.
Toilet paper effect.
Yeah. Remember during the early days of the pandemic when there was a perceived shortage of toilet paper?
Oh, yeah.
So everyone went to the store and bought 3 times what they actually needed, creating a massive, self-fulfilling shortage based entirely on panic.
Panic ordering driven by scarcity fears. Absolutely.
Exactly. Analyst John Franzreb essentially asked if this exact dynamic is happening to Powell right now. He asked if customers are just vying to get in line, placing massive orders today just to reserve Powell's factory capacity out of fear that if they wait, they won't be able to get the essential electrical equipment for their data centers.
Right.
The underlying question is, are these $1.6 billion in orders rock solid, or is there a risk of a phantom backlog filled with speculative duplicate orders that could vanish overnight if the AI market cools down?
It is a brilliant, highly critical question by the analyst, and Cope's honesty here was genuinely refreshing.
What was his response?
He said, definitively, as of today, the $1.6 billion is solid. There are no phantom speculative orders currently inflating that number. They have hard contracts.
Okay, so that's good.
Yes. However, he admitted that customers are absolutely engaging in those panic conversations right now. Hyperscalers are coming to Powell asking how they can reserve factory capacity for years down the line, essentially trying to buy a spot in line.
Wow, just trying to lock down the factory.
Exactly. Cope acknowledged that managing this locking capacity dynamic is a major future risk they are monitoring closely. They do not want to fill their future backlog with speculative reservations that might get canceled if a tech company changes its mind. They want sticky, long-term, structurally sound relationships.
Speaking of expanding relationships and increasing their technical moat, we have to touch on a fascinating technological acquisition mentioned in the transcript, REMS-DQ.
Ah, yes. REMS-DQ.
Powell acquired this UK-based company recently, and according to the transcript, it is already bearing fruit and winning contracts in the US market.
REMS-DQ is a brilliant strategic acquisition. If Powell's massive steel switch gears and copper bus bars are the heavy metal brawn of the operation, REMS-DQ is the software and logic brain that can be integrated into it.
So it brings a high-tech layer to the heavy manufacturing.
Exactly. They specialize in advanced protective and control logic, specifically for high-voltage utility connections and smart grid integration. Cope noted that having this proprietary technology in-house is already winning them new business, including their first major order for a high-voltage control and protection substation.
So it's not just a metal box anymore.
Right. By integrating REMS-DQ, Powell is no longer just selling the physical metal box. They're selling the advanced smart grid technology that controls the box, monitors the grid, and prevents failures. It allows Powell to capture a much larger percentage of the total value of a massive infrastructure project.
Okay, before we bring all of this together for a final verdict, our bottom line, I have to bring up a massive nugget that was buried deep in the Q&A segment.
Okay, let's have it.
An analyst asks, almost as an afterthought, if the board of directors has considered a stock split. And Brett Cope says, yeah, we have, and it's a very active discussion. Now, a stock split usually generates a massive amount of retail investor excitement, right?
It absolutely does, because it lowers the nominal share price.
Right.
If a stock is trading at, say, $300 and splits 3 for 1, it suddenly trades at $100. It doesn't change the fundamental value of the company at all, but psychologically and practically, it makes it much more accessible for smaller retail investors to buy whole shares, which often drives up trading volume and interest.
But Cope's reasoning for actively considering the split wasn't about appeasing retail traders, which is what I found truly insightful.
No, it wasn't. He didn't say they want to do it to pump the stock price. He explicitly tied the idea of a stock split directly to employee retention. He said using equity within their compensation structure is at the forefront of their board discussions.
Which ties perfectly back to the fixed-site engineering bottleneck we just discussed.
Precisely. In an incredibly tight labor market, where specialized senior electrical engineering talent is the single biggest bottleneck preventing you from scaling your billion-dollar backlog, being able to grant affordable, attractive stock options to your key employees is a massive retention tool.
It gives them a piece of the pie.
Right. A lower nominal share price through a stock split gives management far more flexibility to distribute shares and build a true ownership culture among the staff who are actually designing and building these massive projects. You align the engineer's personal wealth directly with the successful execution of the AI and LNG buildouts.
It is a brilliant, highly pragmatic use of corporate finance to solve a real-world human resources problem. Okay, we have covered an immense amount of ground today.
We really have.
We have unpacked the explosive 1.7x book-to-bill ratio and the $1.6 billion backlog. We explored the massive dual catalysts of AI data centers acting as a new growth engine, while Gulf Coast LNG provides a massive resurgence of their legacy business.
And the margins.
Yes, we broke down how they protect their margins through flawless project closeouts and aggressive supply chain judo, and we analyzed their pristine, debt-free balance sheet that allows them to self-fund massive capacity expansions. This brings us to Section 4, the final, most crucial question for anyone listening.
The bottom line.
What is the bottom line on Powell Industries? Actionable and opinionated.
Well, synthesizing everything we've analyzed from this transcript, from the sheer velocity of the orders to the impeccable strength of the balance sheet, it is difficult to arrive at anything other than a highly bullish verdict on Powell's underlying business fundamentals.
I have to agree.
The execution is flawless, and the macro tailwinds are historic.
I agree completely. For an investor trying to navigate a market that feels incredibly top-heavy with, software-based AI valuations that seem to defy gravity, Powell Industries represents a uniquely insulated, incredibly pragmatic backdoor play.
Physical play on a digital trend.
Exactly. You get the long-term, multi-year stability of massive Gulf Coast LNG export terminals and legacy electrical utility contracts, which provides a massive floor. But now that stability is being absolutely turbocharged by the explosive fast cycle growth of AI data center infrastructure.
And crucially, they are capturing this unprecedented growth without sacrificing an ounce of financial discipline.
Right, no debt.
They have zero debt. They're generating interest on a $500 million cash pile. They are self-funding their capacity expansions to avoid dilution, and they are mathematically insulating themselves from commodity inflation through strategic hedging. For those looking for industrial, physical world exposure to the tech and energy tailwinds, the fundamental metrics presented in this earnings call make this a compelling consideration. A clear hold or buy, depending on your portfolio.
It is the ultimate infrastructure play. But we always want to leave you with a final thought to ponder that extends beyond the spreadsheet, something that connects this single company to the broader global narrative.
And thinking about the sheer staggering scale of what Powell has to build just to meet current demand leads me to a highly provocative question for the broader tech market.
Let's hear it.
We see a highly efficient company like Powell having the least new 50,000 square foot buildings, planning massive port expansions, and actively considering $100 million factory ground breaks.
Yeah.
We hear management openly admitting they're scrambling to hire enough specialized engineers just to keep up with the orders pouring in today.
Right.
If this is the reality for the companies building the physical infrastructure, it raises a crucial macroeconomic question. At what point did the physical world become the absolute hard cap on the global growth of artificial intelligence?
Wow, that is a chilling thought for the tech sector, which is so used to infinite scalability.
It is the ultimate unavoidable bottleneck. Silicon Valley can code a new, exponentially more powerful artificial intelligence model in a matter of weeks or months. They can iterate software at the speed of thought.
But you can't do that with steel.
No, as we've seen today, you cannot iterate physical infrastructure. It takes years to permit, engineer, manufacture, test, and commission the heavy metal electrical switchgears required to power the hyperscale data centers that run those models. You cannot download a transformer.
No.
You cannot 3D print a high voltage substation overnight.
The digital revolution, with all its infinite promise, is entirely at the mercy of heavy industrial manufacturing. If the metal isn't bent, the models don't run.
Exactly. The speed of global AI development over the next decade may not be limited by human ingenuity, algorithm efficiency, or software engineering, but by the very physical, very gritty reality of bending steel, winding copper bus bars, and pouring concrete on the Gulf Coast.
We started this deep dive talking about how diagnosing a company's health in this sector can be murky, how the financial x-ray is often blurred by economic static, inflation, and lagged revenue.
Right.
But after thoroughly unpacking this transcript using the talk tickers framework, the diagnostic x-ray for Powell Industries is blindingly bright. They are standing precisely at the exact intersection of the world's two most aggressive capital expenditure supercycles. The muddy waters have completely cleared, and what is left is a company quietly, profitably building the very physical foundation of the digital future, one massive steel box at a time. Thank you for joining us on this deep dive. Keep your portfolios diversified, keep looking for the physical realities hidden behind the digital trends, and we will catch you on the next one.